Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. In the first segment, we talked a little bit about investors out there who are trying to de-risk their portfolio or assume that that's what they're doing, that they've been moving sort of en masse away from stock mutual funds and exchange-traded funds and into either the bond market or very specific sectors of the stock market. And we feel that they have unintentionally just replaced the risk of the market with another risk, that the bond market is not positioned right now to provide much return of it all. They still provide some downside protection when the market goes down. They provide that buffer, but to expect to make very much money from the bond market going forward, we think is a little bit naive. There's a guy by the name of Jeremy Grantham who publishes asset class forecasts, and we've talked a lot about this before, that in the short term, today, this quarter, this 6 months, even this year or two, market returns, whether stock or bond market returns, are very unpredictable. As you lengthen the horizon out to 7, 10 years, somewhere in that time frame, market returns become more and more predictable as you lengthen the time frame. They're more and more predictable, not to return the exact same thing. You see some advisors out there bring out these charts of, well, since 1926 stocks have returned 9%, so they're going to return 9% in the future. That's not what we're talking about. We're talking about looking at where markets are today and looking to the future 7 to 10 years to try to get a feel for what markets will return. Now, the reason is there's this big, powerful factor called reversion to the mean that functions everywhere in life. The biggest example that I think people are familiar with is in sports. If you have somebody that is, say, on a hot streak of shooting three-pointers or free throws, and they've made 20 or 50 in a row, well, at some point that streak is going to end, and slowly over time their free throw percentage or their three-point percentage will revert back to the long-term average of that player. For myself or someone else out there, maybe batting average, the same thing. If we were in the majors, we'd probably have a 100 batting average or less than 100. And you see these guys go on these batting streaks where they have 20, 30 hits in a row, but maybe their long-term career average is maybe they're a 250 hitter. Well, eventually they're going to revert back to that mean. Same thing with you and I. If we were to get in there and we got a couple hits in a row, 3 in a row, and we were batting 1,000, well, that's not realistic to think that it's going to continue in the future. This happens with all sorts of things, that reversion to the mean is a very powerful factor. In markets and in life in general, the problem with a reversion to the mean is you don't know when it's going to happen. But generally what we've seen through studies and things like that is on a, say, 3 to 12 month basis, you see that momentum is a factor. You've got that herding effect, the crowd psychology in markets, that gold is the hot investment or U.S. stocks are the hot investment. And you see that between 3 to 12 months, this sort of momentum continues. But and you don't know exactly when it changes, and when it changes, it usually changes very abruptly and very quickly. But what we see over longer periods, somewhere between 5, 7, 10 years, that things tend to revert to the mean. And that's why we look at these time periods for forecasting. Anyway, so there's a man named Jeremy Grantham, and he owns a firm called GMO. And he's been around, I don't know how old he is, but he's been in the investing industry forever. And there are other sources of it, but we like looking at his methodology, and he has a system that we have adapted to forecast asset class returns over the coming, say, 7 to 10 years. And when you look at the current level of earnings and profit margins and things like that in the market, you're able to look out and say, okay, well, we think that this is going to revert to some sort of long-term average over the next 5, 7, 10 years. And when we do these calculations, what we see is that U.S. stocks in general, U.S. large and especially U.S. small, are positioned right now to achieve zero or slightly negative returns over the next 7 to 10 years. Now, these are what we call real returns after an inflation factor is built in. So if inflation is 10% and you make 11%, there's no difference between that if inflation is 0 and you make 1%. What really matters is the real return, meaning what you made after inflation. It's something that people forget. Last year the market returns were not that great, but inflation was not that high either. If you had very high inflation, let's say last year inflation was running at 7-8%, and you earned 1 or 2%, that really hurts. If returns are 1 or 2% and inflation is 1 or 2%, it doesn't hurt as bad. So the point is that these are real returns that we're looking at. U.S. high-quality companies and international, European companies are poised to return much, much more than U.S. companies over this longer-term time frame, as well as emerging markets. Emerging markets have not been doing as well as the U.S. stocks the last couple of years, and so now they're positioned over the long term to do much better than U.S. stocks. Now, what I really want to talk about, that's the stock market. So we think there is some ability to make some decent returns, 5-6% real returns the next 7 to 10 years in the markets, more so overseas than in the U.S. But the real problems come in the bond market. When you look at the current level of interest rates, you look at the current bond prices, you look at projected inflation and those type of statistics and crunch all the numbers, you see that going into the future, bond returns on a real basis are probably going to be negative. That means after inflation, the majority of bond asset classes, the next 7 to 10 years, the returns are going to be negative. And so all these people flooding into the bond market, when they look back, if they don't make some changes, when they look back 7 to 10 years from now, I think they're going to be sorely disappointed. And so by trying to lower the risk, by moving away from stocks, they may have unintentionally raised the risk. Well, for All Things Money, I'm your host, David Blain. We're going to take our second break for today, and when we come back, we'll continue this discussion.